Hello and welcome to the Tax Roundup. While the government has gone quiet on the tax white paper and the intergenerational report, the ATO have been very busy. First up, we take a look at a major reporting change on how employers need to report to the ATO. We look at the tax deductibility of working with children checks, and we look at two really important cases that have lessons for both practitioners and also their clients. One dealing with unreported foreign income, and the second looking at the application of Part 4A to the CGT small business concessions. But first up, Ray is going to take you through the details of a very important reporting change that will require all employers, regardless of size, to report their payroll and superannuation through their payroll systems directly to the ATO. Ray explains.
Now, single-touch payroll is something that's been talked about for a little while, and now we have a little bit more information. It was announced by the government on the 28th of December 2014, but not an awful lot of detail. Now we have a discussion paper which gives us the information that we need to start thinking about how this could actually work. It's envisioned that eventually this will apply to all employers, regardless of the number of employees, regardless of the size of the business. All employers will be required to report electronically to the tax office at the same time as they make payments to their employees of salary and wages, the amounts of tax withheld and superannuation contributions that are required to be made, all that reporting going through at the same time. Now currently, reporting of PAYG withholding obligations and superannuation contributions happens as a minimum once a quarter, possibly a bit more frequently if the employer is a large or medium employer. Going forward, this will all happen at the same time for reporting purposes only. Now, at this stage, the tax office are not requiring the payments to be made at the same time, although they have made a comment in the discussion paper that it could further reduce red tape if all the payments are made at the same time. They do recognise there could be some cash flow issues for employers in relation to doing this, so that is obviously a key factor they recognise, and they are looking for feedback to how this could work and concerns that there may be out there for various stakeholders. Now, the single-touch payroll will become effective from the 1st of July 2016. It is not compulsory at that stage, but employers will be encouraged to participate. After that, employers that have withholding of in excess of $100,000 will be required from the 1st of July 2017 to participate. There will be penalties if they do not, but there will be some generous exemptions. We don't have details of what those exemptions will be. Then from the 1st of July 2018, they are expected to be within a single-touch payroll environment, and there will be very limited exceptions that will allow them an exemption to that. For smaller employers where the withholding is less than $100,000, they have the same timeframes but 1 year back. So from the 1st of July 2017, larger employers are required to do this, smaller employers will be encouraged to do this. But then from the 1st of July 2018, the smaller employers will also be required to do this. It's something that employers are going to have to deal with. There's no concessions at the moment where smaller employers might just have 1 or 2 employees and be doing the payroll in an Excel spreadsheet. Unfortunately, they will have to move to this electronic environment. They will have to get payroll software that allows them to do this. There will also be consultations with the payroll software providers regarding the functionality and how the information will be reported. But once again, it's coming. So if you have comments, now's a really good time to raise them.
Another interesting update from the ATO was on the deductibility of working with children checks. Mike Carruthers explains.
Now, many practitioners will have clients who work in industries where they work with children, and either already will have the requirement or over the coming months or years will have a requirement to obtain a working with children check. The ATO has released some updated guidance around which employees would be able to claim a deduction for the cost associated with having those working with children checks undertaken. Just to break it down into 3 distinct categories. First one, those employees who are currently working with children in a job, earning income, and are required to have that check undertaken and are paying that fee. The ATO has confirmed that they should be able to claim a deduction generally. For those employees who aren't currently working right now, but have a history of continuously working in the industry, the ATO has also said that generally they should be able to claim a deduction for having that check done if it then kind of opens up that next job. Now, that kind of somewhere, it was kind of sitting somewhere in the middle there, but the ATO seems to be okay with that situation where there's that continuous kind of pattern of employment in that industry. The third category is where people miss out, and that's where someone doesn't have that history of working in the industry and is obtaining the check to enable them to get that first job, I guess. In that case, the ATO says no deduction available because there isn't that connection with their current income earning activities. So reasonably consistent with what we'd expect, but I imagine there'll be lots of people out there who will get this sort of question raised by their clients. The numbers aren't going to be huge, but the sort of question you'll hear a lot. So good just to know where the ATO stance on that one is.
In Cases this month, Ray explores an important case before the AAT that demonstrates how serious the ATO are about their crackdown on unreported foreign income. Ray explains.
Now, another interesting case, Wu and the Commissioner of Taxation. This is an important reminder that a tax resident is required to report their worldwide income on their Australian tax return. And also, the tax agent has a responsibility to ask the question, is there any other income from overseas? Are there any assets outside Australia worth more than $50,000? And ask that question every single year. Now, in this particular case, the taxpayer became a tax resident of Australia in 2005, but the issues that were looked at by the tax office only cover the 2009 to 2012 tax years. Okay? Those years were audited. The taxpayer had only put on his tax returns interest income, and for 3 out of the 4 years, employment income from his Australian company. However, in 1995, he'd set up a company in Malaysia. In 2002, he set up a company in China, both before he came to Australia. He had income from those businesses whilst he was an Australian tax resident, and he did not report it on the tax return. This information came to the ATO's attention through AUSTRAC. They had provided the ATO with information in 2010, which indicated that the taxpayer had funds coming from overseas. The taxpayer himself, although not reporting any foreign income on his tax returns for the years in question, had applied for finance to purchase a home in Perth worth $2.5 million, and in the finance application had indicated levels of assets and income from overseas which were not consistent with what he had told the tax office. Now, fortunately for the tax agent, they had records which indicated that they had asked questions about whether there was any foreign income and whether there were assets overseas. For each of the years in question, the taxpayer had indicated no to the question, are there assets overseas worth more than $50,000, even though clearly he had other records and information where he was well aware that his assets overseas significantly exceeded that amount. So in addition to the amended assessments for each of the years, the taxpayer also got hit with a 50% penalty because obviously there was clear recklessness in this particular case, and the court said we're not going to be remitting any penalties because there's absolutely no grounds to do it. The taxpayer had an obligation. It was highlighted to him by his tax agent. He did not fulfill it, so therefore the penalty stands, as does the amended assessment.
Finally, Michael explores a Part 4A case that demonstrates how you can qualify for the small business CGT concessions, but still fall foul of Part 4A.
Now, interesting case that we've seen around the small business CGT concessions over the last month or so. This is an AAT decision, and the reason it's so interesting is because it doesn't actually deal with the technicalities of the small business concessions themselves. This was actually a Part 4A case, and that's interesting in itself because we don't often see Part 4A cases around SME issues. Now, the facts in this case were incredibly complex, so there's no point even trying to explain them. But in a nutshell, we had taxpayers who were looking to sell their business. They were also looking to access the small business CGT concessions. The main stumbling block for them was the $6 million net asset value test. Now, before the transaction, a series of steps, transactions, restructures occurred, which eventually enabled them to pass that $6 million net asset value test. Now, the Commissioner's issue with this wasn't so much whether they passed the $6 million test, it was around those steps that were taken prior to the transaction to get under the $6 million mark. The ATO was concerned that the steps were undertaken primarily for a tax motive. So the ATO sought to apply Part 4A, and the matter ended up before the AAT. Now, the AAT actually agreed with the Commissioner. So the AAT was comfortable that Part 4A did apply here. So the general anti-avoidance rules applied, taxpayers missed out on those concessions, and were also hit with some pretty significant penalties along the way too. Now, just a little bit more background around this. The taxpayers had argued that the main reason for carrying out these steps was asset protection. And it's the kind of reason that kind of gets thrown around there whenever things get done. But the AAT, I guess, was a little bit concerned, and this was the Commissioner's concern as well, that those steps were quite complicated, and the taxpayer couldn't actually explain clearly how those steps related to asset protection. The accountants also, from the sounds of it, weren't able to clearly articulate why those steps were carried out if the main purpose was asset protection. Now, this arrangement, these steps, this scheme, seems to have been driven by a law firm who came up with a really clever way of accessing the small business concessions in this way, but it really does serve as a warning that Part 4A does sit there in the background. If planning is to be undertaken prior to a transaction being carried out, really need to be able to articulate and explain what the commercial or asset protection, some of those other non-tax reasons are, which actually explain the steps that have been carried out. The problem here was that those steps were too complicated and basically no one was able to explain how they related to improving the asset protection position. So the Commissioner had a win, Part 4A applied, and the AAT really confirmed that we do need to pay careful attention to these anti-avoidance rules, as well as the specific conditions you need to meet, for example, under the small business concessions.
And that's the tax roundup for this month. Don't forget, if your firm is not a member of Knowledge Shoppers yet, then you're missing out on access to a help desk, updated work papers, standard client letters and checklists, professional development, client newsletters, and also our technical updates as well. All for the one cost with no lock-in contracts. So why not give Julie a call on 1800 800 232 or visit the website at knowledgeshop.com.au and see what's on offer. We'll look forward to seeing you soon.